And Gene, I understand the logic that the tech companies can continue to put up big numbers and earnings and continue to show growth. But it seems to me that if value is going to start doing better, it's going to come at the expense of those technology stocks. And there's got to be some shift in the valuation thinking. What's happening?
Yeah, thank you, Becky, for having me. Good morning to everyone. Well, first of all, they both can coexist, and while growth and tech in particular has taken it on the chin the last couple of days, and we've seen a little bit of a rotation, is that rotation sustainable? I.e., is it a big R rotation or a small R rotation? Big R means it's going to last for weeks, months, and quarters. A small R, temporary, a few weeks. It's a reopening story. The positive news about the vaccine, people are going to go back to life as we know it. And when that happens, that means that some of the stay-at-home stocks will be under pressure. So that makes sense. The other thing that we're seeing is look what's going on with bond yields. And as bond yields go up, the valuations on tech come under pressure. So that explains a lot of the recent movement, but we don't think yields are going to stay at the current levels. We think they'll drop back down. And the virus has a couple more months to go. So we wouldn't give up on tech. There's a place for tech, especially the FANGs who have just dominant market positions, great revenue growth, great margins, great leadership. Those are going to continue to do fine. But over time, as the economy reopens, cyclicals value, there's a place for them as well.
Fair point on the bond market. In fact, we were just looking at a chart of the 10-year, which showed the 10-year closing yesterday at 0.96%. It's closed the bond market today for Veterans Day holiday. But, watching bond prices, the 10-year tick up back towards 1%, it sounds like it's incredibly low, but it's been so long since we've seen yields like that. That's a fair point on all of this. Hey, Gene, is it a good idea, you think, to distinguish between some of these stay-at-home plays that are purely pandemic plays and then some of the big tech companies that are probably going to see massive growth no matter what happens in terms of stay at home or go back to work?
We do, Becky. I think some of the stay-at-home plays maybe got a little bit ahead of themselves. When you look at some of these companies that have seen their stock price increase 100, 200, 300%, in some instances. And if you look at the PE multiples, the forward PE multiples, some of these companies are at 100, even well over 200. It's hard to make a case that that is sustainable at those levels. They're great companies, are doing well, but as the economy slowly starts to reopen, it's a big difference in how those things are going to continue to perform versus these big, large cap, well-established brands that also have such diversified revenue streams.
Shepard Smith here. Thanks for watching CNBC on YouTube.